Somewhere in the last few years, gold quietly stopped playing by its own rulebook, and almost nobody watching a Federal Reserve press conference noticed the moment it happened. For decades, there was one simple story: every investor learned rates go up, gold struggles, rates go down, gold climbs. Clean, intuitive, and mostly true for a long time. Then it broke. The Fed raised rates faster than at almost any point in modern history, and gold, instead of collapsing the way the old playbook demanded, kept climbing anyway. By the time it pushed into record territory, plenty of professional traders were asking the question you might be asking right now: if the Fed isn't the reason gold is moving anymore, what is? Stay with this, because by the end you'll understand a piece of the gold market most casual investors never learn, the part that's quietly become bigger than any single Fed meeting. Start with the relationship everyone thinks they know. Gold pays no interest, no dividend, no coupon. It just sits there. So when a competing asset does pay you something, a savings account, a treasury bond, a money market fund, holding gold instead means giving up that income. Economists call this an opportunity cost, and it's one of the oldest, most reliable explanations for how gold behaves. Rates rise, the cost of holding gold rises with them. Rates fall, that cost shrinks, and gold looks more attractive again. This isn't new theory. It's basic monetary economics taught in university courses long before anyone was live streaming Fed meetings on YouTube. The relationship gets sharper once you bring in the real interest rate, which is just the rate after you subtract inflation. A bond paying 5% while inflation runs at 6% is actually losing you purchasing power even as it pays interest. That's a negative real rate, and historically it's been rocket fuel for gold, because in that environment, a bond isn't just costing you an opportunity, it's losing you money in real terms, while gold at least doesn't inflate away the way currency does. This one number has explained more of gold's big multi-year moves than almost anything else in modern financial history, which is exactly why the recent divergence caught so many analysts off guard. Gold's relationship with monetary policy goes back further than most people realize, and the history matters because it's the only way to tell when something actually new is happening. In 1971, Nixon ended the direct convertibility of the dollar into gold, closing out the Bretton Woods system that had anchored international finance since World War II. Before that, gold's price was fixed by policy, hovering around $35 an ounce for decades. Once it floated freely for the first time in generations, combined with the 1970s oil shocks and inflation that peaked near 14%, gold ran from that $35 anchor to nearly $850 an ounce by January 1980. What ended that run wasn't a natural cool down, it was a deliberate act of monetary policy. Paul Volcker pushed interest rates above 20% to break inflation, even knowing it would trigger a painful recession. Real rates went sharply positive, the cost of holding gold spiked, and the metal fell into a brutal, multi-decade bear market. If you want a textbook case of the Fed dominating gold, this isn't one man's decision on rates defined the price of gold for a generation. It's the relationship most investors still carry in their heads, and for good reason, since it held up for the following 40 years. After the 2008 crisis, the same relationship ran in reverse. The Fed cut rates to zero and launched round after round of quantitative easing, creating new reserves to buy bonds and pushing long-term rates lower. Real rates fell, turned negative in places, and gold did exactly what the old playbook predicted, climbing from under $700 in 2008 to above $1,900 by the late summer of 2011, right as Washington was locked in a debt ceiling standoff and genuine fears about a U.S. credit downgrade. Standard & Poor's did, in fact, strip the U.S. of its top rating that August, an unprecedented moment in modern American history, and gold's rally captured a period when confidence in government finances was being tested in public. Then came 2013's taper tantrum, a hard lesson in how fast this can turn. When the Fed signaled it might slow its bond purchases, real yields spiked almost overnight as bond markets repriced. Gold fell nearly 30% from its highs within months. Anyone who'd bought near the 2011 peak, assuming the rally would just keep going, learned the expensive way that gold can fall as sharply as it rises with very little warning. So in 2022, when the Fed launched the fastest rate hiking campaign in over 4 decades to fight the worst inflation since the early 80s, most experienced market watchers expected gold to struggle the same way it did after Volcker, the same way it did after the taper tantrum. Real yields moved from deeply negative into positive territory in a short window, which under the old model should have hurt gold badly. For a while it did soften. Then something odd happened. Instead of continuing down as real yields kept climbing, gold stabilized, and by 2023 and into 2024 it pushed to new record highs, even with US rates at their highest in over 20 years. That's the puzzle at the center of this story, because a relationship that had explained gold's price for half a century looked like it was breaking down in real time. When analysts dug into why, the explanation that kept surfacing had almost nothing to do with American monetary policy. It came down to who was actually buying and why. According to the World Gold Council, which tracks global gold demand and supply, central bank gold purchases jumped to some of the highest annual levels on record starting in 2022, and the trend has held since. This wasn't retail investors buying coins or hedge funds trading around a Fed decision. It was sovereign institutions, national central banks, quietly adding to reserves at a pace not seen in generations. To understand why, go back to February 2022, when Russia invaded Ukraine and Western governments froze a large chunk of the Russian central bank's foreign currency reserves that had mostly sat in dollars and euros at Western institutions. For decades, the working assumption among central banks was that reserves held in major currencies were essentially untouchable, a neutral store of national wealth no matter the politics. That assumption broke overnight. If one government's dollar and euro reserves could be frozen as a policy tool, other governments, especially ones with more complicated relationships with the US and its allies, had reason to rethink how much wealth they wanted sitting in assets someone else could freeze. Gold doesn't carry that risk. It isn't a claim on another government's promise, not a line in a foreign bank's ledger that can be blocked by a policy decision. A gold bar in a country's own vault is just gold. That's the appeal that's pushed central banks in China, Turkey, India, Poland, and others to expand their reserves meaningfully in recent years, per public reporting and World Gold Council tracking. None of this is hidden. It's disclosed behavior, and it reflects a real shift in who's buying gold and why. This ties into the broader conversation about de-dollarization, the idea that some countries are trying to lean less on the dollar for trade and reserves. Worth being careful here, since this topic attracts a lot of overblown claims. The dollar is still, by a wide margin, the most held reserve currency and the most used currency for global trade invoicing. According to the IMF's own currency composition data, nothing else, not the euro, not the yuan, comes close to challenging that anytime soon. What's changed is smaller than the headlines suggest. A number of central banks have diversified a portion of their reserves, holding somewhat less dollars and somewhat more gold than a decade ago. That's a real gradual rebalancing, not the dollar collapse some corners of the internet keep predicting. There's a second force behind this, separate from geopolitics, entirely government debt, and specifically growing questions among economists about whether current debt levels are sustainable across several developed economies, not just the US. The Congressional Budget Office projects federal debt as a share of the economy, rising over coming decades under a range of policy assumptions, driven mostly by rising interest costs and spending tied to an aging population. That's not a partisan claim. It shows up in the projections regardless of which party runs Washington, because the math doesn't change based on who's in office. The IMF and the Bank for International Settlements have both published research on how elevated debt across developed economies, the US, Japan, several in Europe, could eventually affect long-term rates and currency stability if left unaddressed. None of that predicts an imminent crisis, but it explains in plain terms why a number of institutional investors and central banks have leaned harder into an asset that sits outside the banking system and can't be diluted by anyone's spending decisions. Gold doesn't care about a country's deficit. It doesn't answer to a finance ministry. That plain unglamorous fact is exactly why it keeps coming up in conversations about long-term fiscal health. Here's where it's worth separating confirmed fact from interpretation. Since financial commentary online tends to blur the two, central bank gold buying really has risen sharply since 2022. That really did coincide with the Russian reserve freeze and a broader push toward reserve diversification. Gold really did keep rising even as US real rates climbed, which historically should have weighed on it. What's interpretation, not fact, is the conclusion that these buyers have gotten large enough relative to the gold market to offset or overpower the Fed's usual pull in the short term. Several analysts at major banks and research shops make some version of this argument, and the data behind it is compelling. But it's a read on a fairly recent trend, not an established law of how the market will keep behaving, and any honest treatment of this needs to hold both of those at once. It helps to ground this in what it actually feels like for people living through it. Take a retiree who spent 30 years building a modest portfolio and years back put around 10% of her savings into physical gold, not to trade it, just to hold it as insurance against inflation, quietly eating her fixed income. She isn't reading World Gold Council reports or parsing Fed statements. What she cares about is simpler: does the reasoning behind that original decision still hold? For her, gold climbing through an aggressive hiking cycle isn't a mystery. It's quiet confirmation that the insurance she bought years ago is still doing its job in a genuinely tough environment for that kind of asset. A family feeling the everyday weight of inflation experiences this completely differently, watching grocery and childcare costs outrun their paychecks. Gold isn't really an investment conversation for them. It's background anxiety about whether their money stretches as far next year. Fed policy matters to them mostly because it shapes how fast that pressure eases, if it eases at all. Their stake in this story is less an asset allocation decision and more just trying to make sense of a confusing economy that shows up at the kitchen table every month. A small manufacturer relying on components with precious metals in them feels it as an input cost, not a portfolio line. Rising metals prices can push up costs on certain electronics or medical devices, and for an owner already working thin margins, that ripple effect from a macro trend most people only think about as an investment story becomes a very real operational headache, whatever the Fed chair says at a press conference. The disciplined long-term investor, the kind institutional research keeps showing tends to beat more reactive traders over decades, handles this by not handling it much at all, sticking to a pre-set allocation instead of abandoning it every time headlines get dramatic. Financial advisors who work with precious metals tend to repeat the same point that applies to any asset class. Position size matters more over time than trying to perfectly time entries around Fed meetings or geopolitical news. And then there's the newer investor who got into gold recently after seeing a headline promising some specific breakout price by some specific date, someone checking the price constantly, feeling excitement and anxiety in the same breath. This is where behavioral finance actually earns its keep, not as an abstract concept, but as a practical check on your own decision-making. Daniel Kahneman and Amos Tversky's decades-old work on loss aversion found that people feel losses roughly twice as intensely as equivalent gains. That asymmetry is a big part of why sharp pullbacks in gold or silver trigger panic selling far more intense than the excitement that drove the original buying, and why markets driven by short-term speculation tend to swing harder than markets driven by patient allocation. The institutional view is worth understanding too, because it looks nothing like a lot of retail commentary online. Pension funds, sovereign wealth funds, and central banks holding gold as part of diversified reserves think in decades, not Fed meetings or monthly data prints. The World Gold Council and the IMF both publish regular reports on the long structural trends in gold demand, central bank buying, jewelry, industrial use, investment flows, and from that angle, any single Fed decision, however dramatic it looks on financial television, is one data point in a much longer story. It would be dishonest to pretend this market has no bad actors. JP Morgan Chase agreed in 2020 to pay over $900 million to resolve CFTC, SEC, and DOJ investigations into spoofing, placing large orders with no intention of executing them. To move short-term prices in gold and silver futures, that's a confirmed legal outcome, and it shows precious metals markets, like most major financial markets, have had real documented manipulation by specific bad actors who got caught. It doesn't show that every price swing or unusual buying pattern is coordinated manipulation. Holding both of those at once, real wrongdoing where it's proven without turning every move into a conspiracy, is what careful thinking about this topic actually requires. So does the Fed still matter to gold?
Yes.
Rate policy still shapes the cost of holding an asset that pays nothing in a sharp new tightening cycle, or sharp cuts in response to a serious downturn would still move gold meaningfully. The same mechanism that's operated for decades. What's changed is that the Fed isn't the only voice in the room anymore. Central bank buying tied to reserve diversification and geopolitical risk, questions about long-term debt sustainability across several economies, and a slow shift in attitudes toward holding assets outside the dollar system have all become tailwinds running somewhat independently of whatever the Fed decides next. Some economists think this is a durable shift, that central bank demand will keep putting a floor under gold even when monetary policy alone would argue for weakness. Others are more cautious, pointing out that buying patterns can shift, tensions can ease as fast as they escalate, and that a sharp drop in inflation paired with much higher real yields could bring the old opportunity-cost relationship roaring back regardless of what central banks have been doing. Both are reasonable positions held by serious people, and the honest answer is that nobody can tell you with certainty which force wins out in the coming months. What you can actually do is watch different things than most people watch. Instead of fixating only on the next Fed meeting, look at the World Gold Council's quarterly demand reports, which break out exactly how much central banks, jewelry buyers, industrial users, and investors are each contributing. Watch whether the post-2020 central bank buying trend continues, slows, or speeds up. Remember that real rates, not the headline Fed rate, are the more precise link to gold's price. And ask yourself honestly whether your own interest in gold comes from understanding these forces or from the pull of a headline promising a specific number by a specific date. Markets shaped by more than one dominant force tend to be harder to predict than the tidy stories told about them afterward. Gold's relationship with the Fed was never a law of nature. It was just a reflection of whichever force happened to dominate demand in a given era. For 50 years, that was usually monetary policy. Right now, it's sharing the room with central banks rebuilding reserves for reasons that have little to do with interest rates, and with a slower argument about government debt that isn't going anywhere regardless of the next meeting. This is a more complicated environment for gold than existed a decade ago, and no one can predict markets with certainty. Anyone thinking about gold or any asset as part of their portfolio should weigh their own goals and risk tolerance carefully, ideally with a qualified financial professional who knows their full situation. Next time a headline insists everything hinges on the upcoming Fed decision, you'll be able to look past that framing and ask the better question, not just what the Fed is doing, but who else is buying, why, and whether that quieter story is telling you more about where gold is headed than any press conference ever could.